The only free lunch is a diversified portfolio.
All right, joining me will be Sylvia Jablonski, Chief Investment Officer of Defiance ETFs, who just last week, they launched the very first autism-focused ETF. It's the Defiance Autism Impact ETF. The ticker symbol is ASD. And as you might gather, this ETF is designed to provide exposure to companies developing therapies, diagnostics, technologies, et cetera, that help support individuals with autism along with their families. And so we are going to talk about that ETF and the motivation behind launching this, which there is a personal connection to this at Defiance. So Sylvia will give us the backstory on that. And we'll, of course, get into the construction of the ETF itself. And then from there, we will completely switch gears and spotlight the Defiance Quantum ETF, ticker QTUM, which has been absolutely on fire this year. It's now close to $6 billion in assets. It's up about 45% this year, over 80% over the past year. And so Sylvia will give us a rundown on what's been going on across that space. Now, later, I'll be joined by Wayne Penello, founder and CEO of NextGen EMP, who is behind the Efficient Market Portfolio Plus ETF, ticker EMPB. This is a long-short strategy where they are using a proprietary algorithm to determine which asset classes or sectors of the U.S. market are likely to outperform, along with areas they believe are likely to underperform. And this ETF holds other ETFs to get exposure, including inverse ETFs. So we'll dive fairly deeply into that strategy, which I should note, this is actively managed. And so we'll talk about the algorithm, how much active discretion there is within this strategy. And I'm also curious to hear what the current holdings are telling Wayne about the markets right now. Should be an interesting conversation with a longtime market veteran. So Wayne was actually a NYMEX floor trader back in the 1980s. He has some 40 plus years of experience in professional trading and asset management. Again, should be a great conversation. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let me now first welcome in Sylvia Jablonski of Defiance ETFs. Sylvia, it is always a pleasure. Welcome back to the podcast.
Hi, Nate. Thank you so much for having me. Glad to be here.
You know, I have to tell you, I was looking at Defiance's total assets this morning, and I was certainly aware of the firm's growth, but I didn't realize you were now over $13 billion in assets. And it's funny, I actually went back and checked to see where assets were the last time you were on here, which was like late 2022. Listen to this. Your total assets were about $1 billion at that time, which is obviously very good, but it's not $13 billion. So what's the ride been like for you over the past several years?
Oh gosh, it's been it's been a bumpy ride, right? I mean, we're grateful, and I always say, like, we've hustled for every bit of it, right? We've worked really hard to try to come out with really good products, and we certainly got the memo that we had to compete and we had to bring good products to market. And so I think when I spoke to you back then, and we also had just a handful of products, probably sub 10 or so, and we have over 80 ETFs, and just a handful launched just this week. Like we launched an ETF today, actually at 9:30, so it's open. But yeah, it's been incredible, and we've weathered like the tech wreck of 2022. We had COVID, we had China tariffs, we have Ukraine, we have Iran. It's been an interesting ride being a startup ETF company, but we're super grateful for all of it.
Well, it's certainly been fun to watch from my perspective, and it's just been a tremendous ETF success story. So you mentioned launches. I thought let's start with this ETF that just launched last week, the Defiance Autism Impact ETF, ticker ASD. As I noted at the top, this is the first ever ETF focused on providing exposure to companies that support individuals with autism or other neurodevelopmental conditions. I guess first, talk about the motivation behind launching this.
Yeah, I mean, so, autism diagnoses have risen dramatically over the last couple of decades. 1 in 31 individuals, children in particular, are diagnosed with autism. There's like a $3 million per individual lifetime costs. There's 461 billion of projected cost of autism, but so it's this incredibly important segment of kind of neurodivergence disease that exists out there, and it's something that was very personal to us as a firm. So our founder and his wife, our general counsel, Matthew Belsky and Gabriella Zonbelsky, have a son who has profound autism. And so they have dedicated their entire lives to supporting their son and making sure he gets the right, medical support, behavioral support, education, and, has a chance to essentially just thrive in this life. And the struggles that came with that were really eye-opening for them. And, they really came up with this idea that, what if we could build an ETF that invests in these companies that are working on these, groundbreaking types of advances or education or therapies or services that, benefit the greater neurodivergent and autistic society, and do some good, right? So there are a lot of thematic ETFs out there that are following the next hot trend, and we've got plenty of those, but this is really a personal story here, and I think something unique. It's not meant to be another just healthcare ETF, right? It's the first of its kind thematic that's built around this technological challenge that is impacting loads of families globally.
Yeah, so if we look at the ETF itself, this is index-based. It seeks to track the Defiance Autism Impact Index. You gave the high-level overview. Talk a little bit more about what's actually inside of ASD.
Yeah, sure. So ASD is, so there aren't, it's really interesting because when we talk about thematic ETFs, and you know this well because you write about this type of stuff a lot, right? The idea of a pure play kind of doesn't exist here, but we also wanted it to be true to the theme. And so what you have to do then is really scour the universe, and Verify, does this through their index methodology, but just scour the universe for companies that are involved with drug development that is relevant to autism, to, suppressing autism symptoms, to helping manage the disease and some of the behaviors and consequences, educational tools, right? There's a different kind of way that autistic children need to learn. There's, behavioral education, things like this, behavioral support, digital health solutions, assistive types of technologies and therapies, again, like education, drug trials, things like this. And so what Verify does is they look through the universe of biotech companies that work with all of these things and try to, nail down where there is this kind of value chain that's directed towards the autism ecosystem. And then, at that point, the basket is made, and so you have the ASD ETF.
We've mentioned that this tracks the Defiance Autism Impact Index. I'd love to have you talk more about that process for people who don't understand how this all works. Like, take us from idea to inception, and that Defiance has this idea for an index-based ETF, in this case, for something that's very near and dear to the company's heart, but you need an index to track. And so you pick up the phone, you call Verify. Take us from there. How does that process work?
Well, not to Verify, the really close. So first of all, we've been thinking so much about what do we do in this space. We knew that we wanted to have some sort of philanthropic effort where, we would donate the proceeds of, and by the way, we donate 100% of the profits to autism-related charities and stuff too. So we knew that we wanted to have this type of fund, and credit to Verify, they have so much data and information and research that they have a lot of indices that already exist for new and innovative ideas that perhaps they're looking to get into the marketplace and partner with people on. So it was a combination of coming across some of the work that they have already done in this space, and then working with them to get to kind of the shell of the index that they had, which was excellent, and just trying to bring in some of the ideas that we had together. So it's a back and forth conversation. But, once an ETF is tracking an index and it's passive, it's really the Verify, it's really the experts and the engineers, over there that are constantly, scouring the universe and improving performance and creating this efficient, path for us to get an ETF to the market. So it's just a lot of conversation going back and forth.
You mentioned the philanthropic angle to this ETF. So you plan on donating 100% of the ETF's net profits in its first 2 years to autism-focused nonprofits, is my understanding. And then it's at least 50% of annual net profits after that. Do I have that correct?
That's correct, yes. Yes.
Okay. And before we move on, anything else you would mention regarding this Autism Impact ETF?
Yeah, I mean, what I would say is that, Defiance, you and I talked about this a little bit, but we try to be ahead of, disruptive themes. We try to understand the new technologies that are coming into the market and try to think of ways to craft products that are interesting for our investors and unique. And so if you think about this particular ETF and where we are now, right? Like, as I said, there aren't any pure play autism companies. You have all of these companies that invest their time in doing this. And so we have the best index that exists. But now imagine this backdrop now of like AI and everything that's happening behind it. And imagine if you poured, billions of dollars into this space and into these companies that are trying to come up with pure play autism drugs, like a Yamo Pharmaceuticals, right? It's like a private company. They have awesome results from drug trials that they have for autistic children. It's kind of the only medicine that works as well as it does things like this. You're going to hear stories like that coming into the market. And I think, that combined with AI, combined with the massive amounts of investment that are going to go into this, I think this is like an early stage, tech play, right? This is going to be the future of pharma tech and coming up with drugs for a specific population that just didn't have the coverage before. So I keep your eyes on it. I just think a lot's going to shift in biotech.
All right. So now let's completely switch gears and talk about one of the hottest ETFs in the market right now, the Defiance Quantum ETF, ticker QTUM. As I mentioned, this is now closing in on $6 billion in assets. It's up something like 80% over the past year. I guess first, if you don't mind, let's cover a few basics. And I'll start with, what is quantum computing?
Yeah. So, I think, the kind of like the formal definition of quantum computing is basically a computer that uses quantum physics instead of traditional zeros and ones used by today's computers. So they use a traditional computer could use a 0 or a 1, and quantum computers use qubits, which can be 0 and 1 at the same time. So that means they can do many things at once. Two just super easy examples, like if you're locked out of your apartment and you have like a ring of keys, right? Like the old school, I don't think buildings are like this anymore, but the super that would come with 50 keys and, you try one by one by one by one. That's the traditional computer, right? Quantum computing could like look at all of those keys and try them at the same time, open your door in 2 seconds, right? Or a maze, right? You have to try to go through every single path until you find the right way out of the maze. The quantum computer can try all of the paths at once and show you the way through the maze. And so they're not meant to like replace our cell phones or laptops or things like this. These are very sophisticated computers that do calculations, can process possibilities much faster than traditional computers can. And so what that leads to is this efficiency that can happen in different segments. So drug discovery, they could simulate molecules, they can create chemical reactions far more efficiently and at the same time and on different levels. It's aerospace and defense, right? Cryptography, banks, like calculating, looking at the bank portfolio and every single product they have going. And instead of the risk team trying to run, Monte Carlo analysis on like one swap versus the options trader's trade versus a structured note, that the quantum computer spits out like, this is the risk right now. This is what this trade doesn't do, all simultaneously. You get a clearer picture. It's early stages, but I think a lot of experts in the space project that this could be a multi-trillion-dollar industry, and you're starting to see this become commercialized, like IonQ, for example. If you ask somebody, about that stock a couple of years ago, they probably have never heard of it. And D-Wave, and these companies are like have commercial applications now of quantum computers. They're proving that things work, and so again, it's very early, but this is that ChatGPT moment for quantum computing. We're looking at it right now.
Yeah, and to your point, it is early, but there is a lot of buzz around this space. I guess talk more about that and perhaps just how you describe the overall investment case in this space.
Yeah, I think, like, again, I would say this is the next gen of AI and supercomputing, right? So what you have are these companies that are, essentially building quantum computers. They're licensing quantum technology through cloud and through different services. They have agreements with some of the hyperscalers, Amazon, Google, whoever it might be. Quantum computers have been used to make bond pricing more efficient. For example, there was the HSBC news was out there a couple months ago that kind of the calculations came within seconds, and they found this more effective and efficient way to price bonds for trading and things like this. But So what'll happen is you have these pure play companies, and that's like the IonQ, the D Waves, the Quantinuum. That's a great new IPO in the market. And so those are kind of like the small cap growth, the higher risk, the high beta, right? And they're really getting a tailwind right now in the market as AI chips and all things related to AI and machine learning are thriving. The way we think about it with quantum computing, though, is actually a lot of the companies that are spending a ton of money for quantum research and are going to be leaders and players in quantum research are also NVIDIA. It's also IBM, right? It's also these hyperscalers with strong moats, huge balance sheets. They're changing the face of quantum computing. So we have an ETF that combines all of those with the pure plays. And so investors like our ETF because it's this idea of like, well, which one do I pick? Is it D-Wave? Is it IonQ? Like, who's going to be the winner? What happens if that company's pre-revenue? What happens if it goes bankrupt, right? So if you get this ETF that has the broader diversification and the ballast of the quality names with the small cap, hyper growth names, works out really well. And that's why we think quantum's doing so well. For the investor that just wants the pure play, we also have QTUP, which is just the pure play stocks, right? So that'll be a higher beta, that'll be a higher risk. Like you just want the pure plays, you kind of just want that exposure, right? And so there's different ways to play the space. And I just think, the quantum ETF has just grown billions in the past year. It's been picked up by all the wirehouses and institutions, and it's really been the ETF of choice for quantum computing. So we're super happy about this one.
We've talked about how it is still early here, and then you were just touching on the benefits of taking a diversified approach to this space. And I'm curious how you view active versus passive here, because QTUM, this is index based. And we should note this was the first quantum computing ETF on the market. But how do you think about that? Because some people may say, well, if it's actively managed, you can go theoretically pick the winners and losers in an emerging space. But this is index based. What do you see is the benefits of that?
I think, I see the benefits of both because we have the active one too, or we can just pick the pure plays, right? So we believe in both ways. I think it depends on the investor. There are some investors that just want that pure play targeted exposure to the handful of, quantum companies that exist. And by the way, there aren't that many of them, right? And they will, on down days, they will pull back. And when quantum's getting a tailwind, they could outperform and get, kind of hyper performance, right? So higher risk, higher return. With the broader diversified basket, we like that because I think for the average investor likes the idea of having, a ballast, a hedge, diversification. So they're getting exposure to the entire quantum ecosystem, the pure play quantum companies that run the technology, but also the large scale, hyperscale companies that invest in quantum computing and are also breaking ground with it. Really hard to argue that NVIDIA isn't going to play a huge role here, right? So I think I think both ways are a great way to have exposure to quantum computing. And, one necessarily isn't right over the other. What I would say, and this is a bold statement, like I would rather have exposure to a quantum ETF than kind of a classic tech fund, because a quantum ETF gives you exposure to quantum, to AI, and to machine learning, the future of supercomputing. And I think that's the future of tech.
Well, and we just saw here fairly recently the Trump administration announced an approximately $2 billion federal funding initiative around U.S. quantum computing, and that included a large package to IBM. Do you want to talk a little bit about that?
Yeah, and I think you made the point, and the point is that there's just so much government investment in this space. So billions of dollars are actually going to some of these quantum companies for R&D. It's got government backing, and the reason for that is there's this huge interest in geopolitics, aero defense, war, AI, and things like this. And quantum computing, without a doubt, plays a huge role here. So I think that the fact that you have this ongoing commitment and also a global race to invest in quantum computing is another tailwind for the theme.
All right, a few minutes left here. If we move beyond the quantum computing ETF, I'm curious, is there another ETF or two that you'd like to highlight from the Defiance ETF lineup? You mentioned, having roughly 80 ETFs in all. I know you love all of your children equally, but anything standing out to you at the moment, or even upcoming launches? Because you have some SpaceX related ETFs coming to market. You have a lot of interesting products out there. So what has your attention right now?
Yeah, I mean, I would say AIPO is another great ETF that we've just seen so much interest in, and that's the AI power and infrastructure play. It's just this idea that there's such growth with AI and data centers, machine learning, all this kind of stuff. You're going to need the electricity, you're going to need photonics, lasers, all of these things to power this, to actually move data. And this continued infrastructure is just going to continue to explode as AI builds out. So that's been a huge winner for us. There's been a lot of flow into that ETF. But if you ask me about this week, one of the things I'm most excited about is the SpaceX IPO on Friday, and the fact that we're launching SPCU, which is a 2x daily SpaceX ETF. I just think that the excitement is palpable. Everyone on Wall Street's talking about this IPO. Everyone everywhere is talking about this IPO, and we're super excited to, have products in there and give investors that 2x exposure to SpaceX, which they will undoubtedly like for the proper investor.
And how are you thinking about product development overall? I mean, you mentioned these SpaceX ETFs. There's going to be a tremendous amount of buzz around that IPO, to your point, and it looks like you may be able to have a product immediately. But I feel like Defiance has done such an excellent job of capitalizing on big themes and having the timing right, which, as you know, is not always easy to do in the ETF space. Can you just talk a little bit more about how you think about product development at a high level?
Yes, and it's very much being a first mover, looking at the different products in the market, trying to figure out what's missing, trying to figure out where the puck is going in terms of technology. And AI is a great example, right? So you had the ChatGPT, you had the AI ETFs, semiconductors. Well, what's next? Well, someone's going to have to power this stuff, right? What else happens with AI? Well, military uses AI and drones and things like this. So you kind of see how the brain works. It went to AI powered infrastructure. It went to JEDI, the AI and warfare ETF. I would say we have unique launches. Like our most successful launch of the last couple of weeks is an ETF on Poet, POEL. It's 2X Poet. That's the name that probably people haven't heard of again a year ago. So we really try to find disruptive technologies that have, sticking room to be here for the next decade. We think they'll be at the forefront of the next decade of technology and disruption. And, we're well diversified as well. Try to be unique. And the other thing I'll say, which, I've heard you talk about this too, everything is moving so fast in ETFs. Like if you have an idea, you have to file for it the next day because everyone has an idea, right? There's so many exciting things happening. And so we're competitive. Like we don't, we don't sleep. We're in it. We want to get our products out. So we work quickly and come up with good ideas and try to get them to market.
Yeah, I just cover the space from the outside, and I can barely keep up with everything occurring. You're competing, you're in the Terror Dome, and it is tough. It's just a fire hose of new launches. But Sylvia, congratulations on all the success Defiance is having. It's such a great ETF story. Congratulations on the launch of the autism-related ETF. Certainly wish you the best of luck with that. But I always enjoy connecting. Thank you for joining me.
Me too. Thank you so much. And thank you for highlighting what we think is actually an awesome ETF.
Thank you. That was Sylvia Jablonski, Chief Investment Officer of Defiance ETFs.
Navigating the ETF market? Get the precise data and analytics that smart investors rely on. Build a stronger portfolio today at etfdb.com.
I'm now joined by Wayne Penello, founder and CEO of NextGen EMP, who is behind the Efficient Market Portfolio Plus ETF. The ticker symbol is EMPB, which, as I noted at the top, this is a long-short strategy that uses a proprietary algorithm to help determine positioning. And Wayne himself, as we'll get into, he has some 40 plus years of experience in the markets, both on the professional trading side and within asset management. And he's now joining me from Texas. Wayne, welcome to the podcast. It's a pleasure to connect.
Well, it's great to be here today. Thank you very much for having me on your show.
All right, so let's jump right in here on the ETF. This came to market about a year and a half ago. I know you have an extremely experienced team behind this, which I actually had an opportunity to meet some of them at the Exchange conference earlier this year. But let's start with the overall backstory on EMPB. I'm curious when the idea for this ETF was first hatched, and then talk about bringing it to market.
I've always been involved in risk management, and we'll talk about my background a little bit later. But to make a long story short, after I sold my business, I looked to invest. And I realized that the investment community diversifies risk away rather than manages risk as a whole. And there weren't any commercially available products where risk was managed. So I started to look at, since I built algorithms for trading purposes before, I started to look at ways that I could identify times that we wanted to be in or out of the market. And then I read a book by Charles Ellis called Winning the Loser's Game. And he points out, I think it's on page 25, that if you miss the best 90 days in a 10-year period, your investment in the S&P 500 would, instead of growing by a compounded rate of 5.5%, well, actually, let me rephrase it. Instead of growing by $5.50, your dollar would shrink by 22 cents. So he made that as an argument for not timing the market, which was kind of shooting a hole in everything I was trying to do. But then he pointed out that if you miss the worst 90 days, your dollar grew by $43. And when I read that, the light bulb went on. I said, well, what if this is an allocation problem, not a timing problem? So I started to approach the problem that way. And that really is the nucleus of what we're doing. We want to be in the market all the time, but we want to be in the right things.
And this may be obvious now, but why bring this in the ETF wrapper? What had you head down that path?
I've run a commodity hedge fund before, which was only open to qualified investors. But I'm really glad you asked that story, because there are 150 million American households with retirement accounts, IRAs and 401ks. And the median value of those accounts is about $90,000. And it's hard for a registered investment advisor or professional financial advisor to help those people, because how do you make money on a $90,000 account? Your time is valuable. So my goal in offering this as an exchange traded fund is to help registered investment advisors when somebody comes along and says, listen, you have a small account. I don't have the time for that, but you can do this. Or the individual investor is trying to help themselves. If they, buy extra mushy peanut butter, EMPB, but if they buy extra mushy peanut butter, they can have confidence that it is got broad market exposure and we're managing the risk. And so it has significantly less risk in the S&P 500.
And we're going to get into the nuts and bolts of that ETF, but we both have alluded to your background. Talk more about that. I mentioned the 40 plus years of experience. I know you were a NYMEX floor trader back in the 1980s. Talk a little bit about your career path.
I was working on my PhD in oceanography. And the interesting thing or parallel between markets and oceanography is they both deal with chaotic systems. And that was just about the time where work by Mandelbrot and Gleck was just coming to the surface, and people were understanding that you can use statistical tools in a chaotic system, but you can't use them the same way. And basically, to make a long story short, in a chaotic system, too much data is noise. So you have to organize the data in a way that lets you filter out the noise and see the signal. I saw this opportunity initially by investing in gold and silver, and when the Hunt brothers cornered the market back in '79. And then I said, well, this is a lot more fun than being an oceanographer. So I went to Wall Street. I was a NYMEX floor trader for 10 years. I was ring chairman of options and head of the settlement committee. So that means every day at the end of the day, I'd sit down and I'd settle the hundreds of option settlements long before we had laptop computers. I mean, you just had to kind of do it in your head. Left the floor, managed risk for the global world's largest independent trader of oil and gas, Vitol. I was their global risk management guy, and they wanted me to live in Europe. That didn't really work for me because I was working 24/7. And I came back to the States after a couple of gigs, started my own consulting company, Risk Revenue Energy Associates. During that time, I patented an algorithm that quantified commodity price risk in budgetary terms, and our oil and gas customers that use this algorithm paid $13 billion in bottom line receivables for following that. Forbes got wind of the patent and the success of the patent, so they asked me to write a book called Risk is an Asset, which I think you can see behind me. And when I wrote that book and published it, one of my competitors decided to buy me out. And when I was, however modest it may have been, when I was given this windfall, I just needed a better way to invest it, and I decided to invent one.
I love that. And now here we are, you're in the ETF space. And so let's talk about the EMPB ETF. I'd love to have you just take us through the investment process here. This is actively managed. Talk more about what exactly is going on underneath the hood of this product.
Well, I think it was Markowitz who said, Nobel Prize winning, Markowitz said, the only free lunch is a diversified portfolio. And all of the great financial work that is the foundation of our industry today, all that stuff was done in the 1950s and 60s, and it really hasn't been updated. And so some of the things that have changed that have a material impact on how we invest is, in the 70s, you didn't know what your stock price was till it came out in the paper the next day. You had huge transaction costs. You didn't have the liquidity that we have today, and you didn't have access to information, and also didn't have nano traders and all of these different layers of money managers. So I decided to take another look at how one could improve a diversified portfolio. And as I said to you earlier, I was thinking about when to be in or out, but then I realized that what I really needed to be was an allocator. And so I did this test called a crystal ball test. And well, I call it a crystal ball test. And I took a portfolio of ETFs. If you bought and held them for 10 years, they might have returned something slightly less than the S&P, let's say 8 or 9%. But then in each one, I said, if I have a crystal ball and I know next month that oil and gas is going to outperform the S&P, or the S&P is going to outperform oil and gas, I'm going to own the one that does better. Whether it goes up or down, I'm going to own the one that does better. And it turns out XOP stands out in my mind. It went from a compounded loss of 2.5% a year to a compounded gain of 45% a year, if you had a crystal ball, which nobody has a crystal ball. And as you did this across the board, you found that you lifted returns by about 20% a year if you had the crystal ball. So I set out to build an algorithm that I like to call is a foggy ball. And our algorithm is right about 2/3 of the time. And overall it creates about 1% alpha a month. And so I started to allocate that to a long only program, which did a great job in lifting returns, but didn't manage the risk nearly as much as I wanted. We only had a 20% drop in risk. So to put that in perspective, the S&P 500, you have a 95% confidence that you will not be down more than 25%. But you have a 5% chance you will be down more than 25%. And so by using the long only algorithm, we were able to bump that up to about 20 or a 95% confidence. You only have an 18 to 20% loss. And then when we looked at the shorts, the ETFs that were excluded, the ones that we didn't own, and we included them as shorts on a 50% ratio. And that ratio is important because it avoids margin costs. And we did that. All of a sudden, we didn't impair returns. That means the shorts didn't make or lose money, but our maximum drawdown became 10%. So a significant risk reduction. And that's what we were seeing. We're not trying to make as much money as other ETFs that dial in that, if you had been long semiconductors for the last 3 years, you would have made BOCO amount of money. We're not trying to be that guy. What we're trying to do is produce a product or provide access to individual investors that I can buy this. I know I'm never going to lose. I have a very high confidence. I'm never going to lose more than 10% of my money, so I can sleep at night. And over the next 3 years, I expect to generate a market competitive rate of return and perhaps even slightly better.
And with what you're calling the foggy ball, and I should note, my crystal ball is completely broken. It shattered a long time ago. But
they all are.
This proprietary algorithm, what are some of the key inputs and outputs? Just give people a flavor for what's actually going on here.
So what drives prices? Capital flowing in or out of the individual asset. And so individual stocks are very noisy because of management decisions or outside factors outside of the company that have a direct and meaningful impact into the operations of a firm. So our algorithm looks at industry sectors rather than individual companies. So we're a fund of funds. And what we're looking for is what I call relative strength. It's, is this industry sector likely to match or outperform the average? And so basically what we're trying to do is whittle out the ones that will underperform the market. And as I said a few minutes ago, the industry sectors that the algorithm likes, those are the ones that we allocate AUM to. And then the ones that it doesn't like on a 50% basis, we go short those. And the great thing about an exchange traded fund is you don't need an uptick to go short. You can go short at any time. That's very helpful. The other great thing is that we're using the asset base of the long portfolio to collateralize the short portfolio. And then here's the sweet part. I mean, I just love this. As an exchange traded fund, when we go short those ETFs, we collect the cash and we hold it in our bank account, and our investors make that interest. So we're actually generating about 1.6, 1.7% a year interest on our short holdings, which goes directly to the investor and offsets almost all of our fees.
And so if we look at the current positioning within this ETF, and you don't need to rattle off every single holding, but what does that look like right now? What are some of the current holdings in there that stand out to you?
Well, the things that we've been persistently long are semiconductors and the NASDAQ. And I think if you look at their returns, you'll understand why. And we're currently long them this month. We're also long solar, which I think is kind of interesting. And then we're short just a few things. We're short minerals and mining. We're short materials. Remember, we rebalance every month. So we're dealing or focusing on what we think is going to happen in the next 30 days. And maybe we hold a position for a long period of time and then finally go from long to short or short to long. Like we just flipped from long to short in Kathy Wood's ARC. And but what we're really looking for in our portfolio is historical performance that, from the algorithm's perspective, is predictable, not in terms of whether it's going up or down, but relative performance. Will it match or underperform a benchmark?
So with that algorithm, are there ever instances where the algo tells you to do one thing, and let's say you personally vehemently disagree with that, and so you don't follow what it's spitting out? Like, how much active discretion do you take?
So we want to separate that. What you're asking is tactically, do we take any discretion? So let's start with strategically. We have a portfolio of about 60 ETFs that are eligible. Let me rephrase it. We have a quiver of about 60 ETFs that are eligible to be in the portfolio. We're currently trading 18 of them. And the specific balance are, we had to choose which 18 we're going to use. And then we have to decide what the on-off thresholds are to be long or short. But once that's set, we go with that portfolio, and tactically, whatever the algorithm says to do, we do. And I will tell you that historically, when we were developing, the beta models of this, because we traded this as SMAs for about 4 years before we launched it as an exchange traded fund. Every time we overrode the algorithm, we regretted it. I mean, every single time. It was like 12 for 12. And we just said, stop doing that. It's not going to be right all the time, but it's going to be right almost all the time. So let's just go with that. And the only proviso I'll say is every once in a while, because of the distribution of long and shorts, it might want us to take a 25%, might make one position 25% of our portfolio. And we don't let that happen. We try to keep it under 18%. So we just tweak it a little bit, but we definitely directionally go, whatever the algorithm says to do, we're doing.
Okay, so in many ways, I would compare that to any rules-based process in the investment world. Again, you're following the algo. But let me ask you this: the goal here clearly is alpha generation, as you've noted. And so let me ask you the cliche question, which is that I'm sure you've seen all the data out there regarding the longer-term underperformance of active managers. Now, we just said you're more rules-based here, but the point is it can be very difficult to consistently outperform over time. So how do you buck that trend here with this ETF?
Well, simply, we take probability and we stack it in our favor. So, buy, hold, and hope works because the market has three tailwinds, right? Innovation, increased population, and inflation. So long as we have those three factors, eventually stock prices are going to be higher. The great thing about even passive ETFs is that they're not completely passive. My favorite story is that in 2001, when Enron collapsed, and the S&P had to remove Enron from the S&P 500, it replaced it with a fairly unknown chip company back then. And you might be familiar with today, it's NVIDIA. And so since 2001, NVIDIA has generated a compounded rate of return of 47,000%. That is, your $1,000 grew to $470,000. So even in these passive funds, by having a portfolio of those, you have some of the industry's most talented traders who are optimizing which company should be in my industry sector passive fund. But I mean, these are people who manage billions and billions of dollars. They're some of the highest paid people on Wall Street. They know what they're doing. Trust them. It makes a lot of sense to own that. We add another layer on that. So we're the head coach of a Super Bowl team with some of the most premier players in the industry, all working for us to make the individual components of our portfolio work and generate rates of return. Then we have this algorithm that, because we organize the data properly and have insights, we're able to identify where the strength is in the market, and we own that. And that in and of itself would make us a lot more money, but the problem is it doesn't, as I said earlier, address the problem of risk management. And few people, when they're in their 50s, or let alone those that have retired, are willing to suffer a 25% drawdown in their account. So we built, as I said, we built an exchange traded fund that has a 95% confidence you will not be down 10%. And our track record in the 18 months we've been operating, the S&P has been down 7 of those 18 months. We've been down 4, but in the 7 months that the S&P was down, it was down an average of 2.8%. In those same 7 months, we averaged a gain of 0.5%. And since inception, we're up over 30%, beating the S&P by about 9%. We have a Sharpe ratio of 2.2 versus a Sharpe ratio of about 0.85, 0.9 in the S&P. So, which roller coaster ride do you want to be on to making yourself wealthy? Do you want to be on the one that rips your head off every now and then, or you want to be on the one that puts you to sleep because it's boring?
Yeah, and you mentioned obviously trying to find areas of strength in the market, but also having this component of risk management. And I'm curious, Wayne, when you look at all of the current holdings in the ETF right now, when you look at them all together, what story are they telling you about the markets right now? Like, if you had to use those current holdings to write a book, what would the key themes be?
One, it's not a trend. So the only trend that I'll say is you've got semiconductors and industries that support the semiconductor industry that are arguably doing well because of the trickle down effect. I mean, AI needs hardware. Hardware needs materials to produce it. Materials need electricity to produce the materials and to operate the hardware. So all of these things will eventually trickle down, and that's why I'm very bullish on our economy, because I think AI is bigger, is going to have a bigger impact on our economy than electricity did back in the 20s. So what I see is you have mean reverting industries that, like healthcare, for example, it's only going to grow so fast. So once it's near its recent highs, it's just a hard time for it to go much higher. But then you've got trending industries like materials and metals, which we saw over the last couple of years. The gold and silver, just, you couldn't stop it from going. And it's interesting, if you look at a 20-year history of gold. I mean, gold lagged behind the S&P 500 for about 17 years, and then in 3 years it just caught up. Right. So it's I would simply say that we're going to have a stronger economy, and you've just got to be sensitive to which parts of the industry are participating when.
All right. So where does EMPB fit in a portfolio? Like, how should investors think about this ETF in the context of overall portfolio construction? Is this an S&P 500 type exposure replacement? Do you view it as a complement? Just talk about portfolio application.
It's an S&P 500 type replacement. You could probably own twice as much of it. So instead of having a 60-40 portfolio split with S&P versus some sort of treasury or bonds, which will then reduce your risk from 25% down to about 15%. This has 10% risk. So you basically could go almost completely into EMPB and have the confidence that you're never going to have more than a 10% drawdown. I know nobody's going to do that, but what we do with our clients is using that 10% metric is ask them, if you were to have a drawdown in your account, what would you be comfortable with and not worried that you were going to have your head ripped off? And so we just back into that. If somebody with a $200,000 account is willing to be down $20,000, well, they can be 100% in EMPB. What we typically do is we probably go about 70% EMPB to keep some dry powder, because if we ever get a 3 or 4% pullback, we'd like to participate in that. So speaking to RIAs, it simplify your life. If instead of trying to build a customized portfolio for all of your customers, if you own EMPB, one, you know what everybody's got. You're only tracking one thing. And so it's very easy to determine whether it's working or not. And then more importantly, it simplified your life to a point where the add-ons that you want to plug into their portfolio become a much easier process, because you're not filtering through a very complicated portfolio to get to where you want to be. And if we're talking to individual investors, for them, this just simplifies your life completely. You're just looking at two things. How much bond exposure do you have, and how much equity exposure do you have, and are they working?
In just a few minutes left here, I always like to ask about due diligence. And as I know you're well aware, there are obviously other long-short ETFs on the market. And so before I let you go, what should be some key considerations for investors and advisors as they look at those ETFs along with your ETF?
Let me say that on my website, you have my email address and telephone number. So as I described this, if you're interested, I will actually provide you the programming in Excel to do this. But a chart that is terribly underutilized is tracking the high watermark of an investment versus where it is in any point in time currently. And what you want to look at is that drawdown in percentage terms. So if you were to track the high water mark of the S&P 500 versus its drawdowns, you'll see that routinely it drops 25%. If you look at NVIDIA, that number is 50 to 70%. It's a huge number, and the recovery period during that. And so by analyzing what your portfolio looks like, and you start out with individual pieces, but looking at the high watermark versus potential drawdowns, it tactically tells you, okay, I want to buy it, but do I want to buy it all now? Because can I expect a 5 or 10 or 15% drawdown? And that's probably when I should buy it. So I get better pricing in my portfolio.
And you mentioned a website. What's that website address?
So our website is nextgenemp.com. And we disclose our positions every day on that. We have some discussion of why, the history of long short funds and why I think they're so important. And ultimately, I think there'll be many more of them going forward. But what you really want to track is the gap between how the all-time high versus where the market dips to before it makes into the all-time high. Because unlike the Sharpe ratio, which is a nice number, I mean, I help people understand the Sharpe ratio. The S&P has a Sharpe ratio of about 0.8, 0.9, which means that for every dollar at risk, you're expecting to make 80 or 90 cents. Ours has a Sharpe ratio of 2.2, which means for every dollar at risk, you're expecting to make $2.2. All right. And so now how do you allocate that to your portfolio? Well, it still is in percentage terms. So if you go back to this all-time high chart that I'm describing, it really puts this in perspective so that investors can manage their risk more effectively. If they do that, they're more likely to weather the challenging storms we inevitably get, which means that they'll be in it for the long haul and participate in the overall gains that we expect the market to make.
Well, Wayne, I really enjoyed hearing more about the EMPB ETF this week. Certainly wish you and the team there the best of luck moving forward. Thank you very much for joining me.
I'm really thrilled that you had me on board. It's just great to get some exposure to individual money managers and individuals that are trying to help themselves. And I'm hoping that someday people are, if it's not me, if it's somebody comes up with a better mousetrap, but I think ETFs are making it possible for risk management to become an integral part of every investment portfolio.
Well, again, thank you for joining me. That was Wayne Penello, founder and CEO of NextGen EMP. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I will be joined by Brian Lake with Goldman Sachs Asset Management. So we'll be talking Goldman ETFs, the Innovator ETFs acquisition, and much more. And then I'll also be joined by Nico Lacua, who is co-founder of Corgi. And Corgi has absolutely burst onto the ETF scene with record-setting launch days, including 35 ETFs last week. So we'll discuss their overall approach to the ETF market. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with Verify or any of its affiliates. Verify's participation in this program should not be construed as an endorsement or an indication by Verify of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.